Cash flow analysis. This is chapter 9, and this presentation is the first part of chapter 9. Following are the learning outcomes from this chapter. After going through this chapter, students will be able to prepare cash flow estimates of a new project or adopted by an organization, conduct the net present value analysis on those cash flows, and be able to determine the feasibility using that NPV, net present value. And finally, compare and contrast cash flows from a financial perspective and also from an accounting income perspective. So let's compare and contrast accounting income versus cash flows here. An organization makes profits, and if these profits are all credit sales, then there are very little cash flows because cash is not generated from those sales. So liquidity, as we might recall, is the ability of anyone to convert any asset into cash. And if this liquidity is missing, then the ability to convert into cash flows from a project becomes hard. So if we apply the net present value rule, we must first be able to forecast the cash flows from a project. We also must be able to estimate the opportunity cost of capital or the available option that is the next best option to the project that will generate some return R. And then finally, we can compute the present value and the net present value after due consideration of the setup cost. So the setup cost is usually spent at time 0 and hence is associated with cash flow at time 0 defined as CF0. So that's how net present value or NPV is calculated. Now let's look at an example. So in this example, a project costs $375 and the cash flows are 25.51, growing at 10.25%. And the accounting department estimates that the initial setup cost of $375 is depreciated using a straight line depreciation. But financial manager considers it to be an immediate cash expense, whereas the accounting department, for the sake of profitability of the organization, will consider the depreciation part and not the cash flow part aspect. So that's the accountant's perspective. Now, the problem here is, how do you find out the net present value at 10.25%? So we go to Excel here and look at the cash flows. So we set the cash flows up. Hold on, let's just for now not see this. So these are the cash flows now here, minus 375, 25.51, and growing at this 10.25%, as we can see here. So these cash flows are growing at 10.25 until we reach $100 at year 15 when the cash flows stabilize. And the profit essentially is the difference of cash flow, assuming nothing else is happening, the difference of the cash flow and the depreciation. The depreciation is constant, straight line, and therefore it is essentially 375 divided by the lifetime of the project, which is 20 years, so 18.75. And so these are the profit numbers here. And when we take the net present value, it is on the cash flows initially in this cell. So we use the NPV function and we use the initial value of B2 from outside, and we use the rate of 15%, and we use the cells B3 to B22, cash flow from time 1, through the last cash flow, and add it to the initial cash flow, which is negative. So the net present value of this project comes out to minus 82,000 million, whatever the unit is. But bottom line is it's negative. So that means the project is not feasible at an MARR of 15%. And I mean, it probably becomes more feasible at a lower hurdle rate. So like something like maybe 8%. So that's too low. So it's breaking even close to 11 point some percent. I mean, we can easily find that using the IRR. So the equals IRR and the cash flows will tell us what the hurdle rate is. So, and then 11.9%. There you go. So that is where we break even. But that's not the idea. The idea is this: at 15%, the net present value of the profits is actually very high. It's 175.64. And therefore, looking at the present value or net present value of profits does not give us the same picture as a net present value of cash flows. So that's what's going on here. So accounting income is not the same as cash flows when it comes to determination of the feasibility of a project. Okay, now that's the big punchline. So the financial manager's perspective is the project is rejected, but from the accounting department, it can be all clear. So should we go ahead with the project? That's a main concern. And when we are determining that, the most important thing is to determine the incremental cash flows. A firm already exists. It already has revenues and expenses on its other projects. And if it reallocates some of its resources to a new project, then we only consider that incremental reallocation, because the firm would be allocating the resources anyways to the other products and cash flows that it's generating. So when we go to create a new project, we must only look at the incremental allocation of resources to the new project. So the importance of incremental cash flows is very, very high. So CFIT is firm's cash flow at time t with the project, and CFOT is a firm's cash flow at time t without the project. So incremental cash flow is defined as the difference of these two projects. So the total cash flow with the project minus the cash flow without the project is the cash flow thanks to the project. Now sometimes there could be economies of scope, and so projects can get benefited by, the company can get benefited by addition of a new project just because the sum of parts can lead to a bigger whole. And the most important thing is we must consider opportunity costs. So opportunity cost is benefit or cash flow that's foregone by utilizing those resources for something else. So for example, let's say a firm is investing in $1 billion of money. It in purchases of new aircrafts or creation of a hub, or simultaneously purchasing new aircraft and creation of a hub, it foregoes the opportunity of investing it in something else. So let's say it misses out the opportunity of investing in government bonds for 5% interest. So that's $50 million per year. So that's the opportunity cost of those funds. And then we must look at the incremental cash flows generated by investment activities, initial setup costs, terminal scrap value, and if applicable, then cleanup costs when the project is over. Working capital cash flows, initially we have to invest in inventory, raw materials, overhead, etc. by when the new project is launched. So this is investment in working capital. And when the project is over, we usually liquidate that working capital for something else. So cash is generated. That's working capital cash flows. And finally, financing cash flows. No, not finally, but third thing is financing cash flows. If any financing activities mandated, such as issue of debt, equity, etc., that is also considered. And then initially the financing activity cash flows should produce a positive cash flow because we borrowed some money either from the debt market or the equity markets. And then as we repay it, it becomes a negative cash flow as we go along. So that also needs to be considered. And then opportunity costs are very important as we talked about it. So this is an example of real cash flows versus nominal cash flows. Real cash flows should be discounted by real interest rate or real cost of capital, and nominal cash flows by nominal cost of capital. Let's look at this project here. So this project is investing $75,000 at time t0 and produces 5 cash flows of $25,000 each. And these are nominal cash flows. Nominal means actual, real means deflated by inflation. So real rate is essentially a nominal rate minus the rate of inflation. And if the rate of inflation is positive, the real rate is usually like less than the nominal rate. And so this case, we are using a discount rate of 10%. And the present values are as seen in the third column. Now what's important is the net present value of these cash flows is a positive 19,000. 769.7. And let's see that now. So we will unhide those columns that we hid earlier. And so these are the numbers. So we enter those numbers here and take the present value of each of the number. So the present value is essentially that cash flow divided by 1 plus rate. That's 10%, 1.1. 10% is 0.1. So 1 plus rate to the power of time. And so we apply that formula to each one of these, and the signs are already adjusted, and add them up. On the other hand, we could use the NPV function. So here we use the NPV function at 10% hurdle rate of these cash flows. So both of them give the same answer. So that is what we do for nominal cash flows. Now let's understand what the real discount rate is. The real discount rate essentially is 1 plus nominal rate divided by 1 plus inflation rate minus 1. For low values of inflation, this can be approximated as real rate minus inflation. So again, the mathematics is not required. So we assume the rate of inflation to be 2% and use that formula here. So 1.1, which is the nominal rate, plus 1 divided by inflation rate plus 1, which is 1.02, and then minus 1. So this is 7.84%. This is a real discount rate. Now to use the real discount rate, we must have real cash flows. So we have to adjust our cash flows by inflation. There are two methods of adjusting them. We can use whatever we like. So the first method is just divide the nominal cash flow by the rate of inflation to the power of the time. And the second is the nominal cash flow divided by 1 plus rate of inflation, and then take the previous value and keep on discounting it by the rate of inflation. And both of them, as we can see here, are generating the same value. So these are real cash flows. Notice how the initial cash flow at time t is 0. There's no difference between nominal and real because it is what it is right now. So there's no difference. And then we use the NPV function, as we saw again. So this is using the value of the real interest rate, which is 7.84%, and the cash flows that are real. So that's how we get the same answer for all the three NPVs, irrespective of whether we use real interest rates or nominal interest rates. Nominal rates must be used with nominal cash flows, and real rates must be used with real cash flows. So that's how we got the same answer, like here. And that's chapter 9, part 1. Thanks for listening.